Good afternoon and welcome to this talk on talking to accountants, practical guide to how to interface between actuarial and accounting systems. I'm Robert Mumford. I have been working in actuarial systems since about 2004, including stints selling actuarial systems, implementing them, and since IFRS 17 came out, I've been working almost exclusively on implementing IFRS 17, where I've also done stints with IFRS 9, etc. as well. Just a few guidelines to go through. This is to do with US antitrust laws, which I'm not an expert on, so I will expect that you self-govern yourselves here. We can't discuss pricing. I don't plan to. We can't discuss market allocation. I don't plan to. We can't discuss membership restrictions. Again, I don't plan to. Product standardization, not really discussing products. If at any point in this you feel that we're going to violate these guidelines, please just leave. Okay? Don't be bad. Cheers. So, why might we need to interface between actuarial and accounting systems? Well, firstly, there's been a change in accounting standards. So we've moved from IFRS 4 to IFRS 17. That has put a lot more of the emphasis on insurance accounting onto the accountants. So previously, the accountants would do their thing and the actuaries would do their thing, and the actuaries would give a statement of liabilities to the accountants, and then they'd work with what we'd given them. But that would be given at a consolidated level. Nowadays, accountants are much more interested in the nitty-gritty of the accounts. They are personally responsible for anything that goes into the financial statements, and therefore they are interested in how it is being calculated. Elements of the insurance revenue, for instance, is being calculated directly in the accounting systems, directly in the actuarial systems, rather than as an output. It's got to be calculated down at each policy group. It can't be calculated at the top level. And so there's a lot more granularity in the accounts that needs to be allowed for, which means that we need to be passing across a lot more data than before. We can't just pass across a single Excel spreadsheet that has the results of all our standards in. We also have advances in automation. So with the advent of AI, etc., data automation has got a lot better and a lot quicker. You can set up processes that push data. You can set up processes that pull data. You can automatically run processes. Now, to a large extent, you've always been able to do this, but things have got so much better now that why wouldn't you choose to automate systems? Why would you have the accountant working over the weekend just to press a button when you can set it up so that it automatically happens, and then you come in on Monday with knowing that the data's there. We also want to improve data quality. So beforehand, we were handing spreadsheets over to the accountants, and because of the size of the data, etc., there are limits. There's also limits because the spreadsheet you're handing over is generally called final version 5, which isn't great. If you automate it, if you have a push and a pull and a file transfer that automatically names it, automatically does everything, you don't have to worry about any of that. You don't have to worry about data versioning. It's all part of the automation. And that will improve your audit as well, because the auditors know that this is the file provided by Actuarial, this is the file used by accountants. Check, pass. This enables us to streamline the compliance process. You've got a process there automating your system. Once you've ticked it off, all you need to show is that actually you followed this automated process, and that makes it so much faster than before. There's reduced data risk. You don't have your files named final version 5 and they accidentally use final version 4, because there's fewer manual processes. You don't actually need to check it anymore because it's not a manual process. You get a log coming out that says this is the file that was used, this is what you want. It was produced on this date, it contained this many contracts, this many policies. So your data risk has been reduced and you have a faster close. The time between the end of the period and the books closing and the accounts being ready is reduced because the automated robot that you set up to push this system doesn't complain about working at 2 a.m. in the morning. It just chugs away automatically. And the bits that you need the accountant for, the bits that you need the actuary for, they can be done during the day. And so everyone is happy. Your reporting actuaries are not staying up past midnight at year end. They're happily in their beds, studying for their exams, etc., doing all the sorts of things that actuaries do in their spare time. So before we go into automating the process and looking at it, let's briefly look at what is in the accounting process, and then we can look at how we automate it with a slightly better view of what we're expecting. So the first thing that gets done, and this is what's typically classified as bookkeeping. All your transactions are recorded. So if your corner shop buys a whole crate of baked beans, they'll put that in the ledger. When they sell one of those baked beans, they'll put that in the ledger. All these get recorded in the transactions and goes in a journal. We prepare journal entries, we post these to a general ledger, and then we use that general ledger to create an unadjusted trial balance. Now, the key word here is, well, there's two key words. There's trial and there's balance. So what you're doing with a trial balance is you are making sure it balances. You are making sure that there are as many credits as there are debits. You're making sure that both sides of the balance sheet balance. And it is a trial balance because it is a first attempt. This is the beginning of your process. And usually it doesn't work. So you have to make adjustments. You have to go back, you have to look at your data, you have to judge, well, this data came in late, should we record it, should we not record it? Okay, we'll make an adjustment here, we'll make another adjustment. Once you've done that, you then end up with your adjusted trial balance. This is then used to generate your financial statements. This will be your balance sheet, your cash flow statement, your income statement. And having done that, you then generate your disclosures and your note to the accounts. So there's a whole load of other things that aren't in your general financial statements that are still captured and reported to the markets, or reported to the regulators. So what percentage of your assets are in bonds, for instance, is a disclosure that's not necessarily required. And having generated your financial statements and your disclosures, you then send it off to your auditor, and they will spend a good month or so checking through your processes, checking your receipts, checking everything to make sure that what's in your financial statements and your disclosures is a good and sound representation of the state of the business as it is, and that is done in a manner that is in accordance with your accounting principles and other regulations. So looking at the elements of the accounting process here, we have the adjustments. So they're getting rid of the errors in the trial balance as before. We have the journal. So the journal is the chronological record of all the business transactions. So a time and a date of everything going in there. So that's making sure that it's in the period that we're looking at. And every element within this journal has a debit and a credit. And we'll look at some accounting events later and how those are created. The main accounting record is the general ledger. So this is a summary of all the financial transactions. So the elements in the journal are then grouped together into representative accounts. So in the journal, you would have each of your insurance policies. In the general ledger, that would be where they would be grouped together in general. And that would be the level at which you would calculate your CSM for groups, for instance. Although we'll come on to that later. Your financial statements are the balance sheet, your income statement, your cash flow statement, and the statement of the shareholders' equity. Hopefully you'll all have studied all of those in the exams. And then disclosures are any particular accounting policies that you've applied in preparing the accounts, any quantitative information that's material and useful. So, for instance, things like EBITDA, which doesn't belong in the financial statements, but is useful. Qualitative information: is the CEO having a good day? Is he breaking up with his wife? All that sort of thing that could impact the performance of the company that isn't actually put down in numbers. That will be useful here. And then the various notes, why has revenue fallen 10%? Why is income up 20%? How you expect that to change in the future. And then various regulatory requirements as well. So that will vary depending on the regulator. So I wouldn't want to get too much into the details there. There's a whole load of requirements that we have in the UK that you won't have in the US, and vice versa. Moving on. So this is particularly around how we get actuarial systems and accounting systems to talk to each other. But neither of these systems exists on their own. You have data systems that feed into the actuarial system, they feed into the accounting system. There's always going to be analyses done on Excel. You might have input from bespoke systems as well. And generally, every company does this in a slightly different way. And as a systems actuary, the first thing is to work out what systems they're using for what and why. So in terms of the data systems, you'll generally have, for instance, SQL Server, you'll have Oracle or SAS. These are big behemoths. They deal with lots of data and they generally do it very well. And they've generally been very successful in doing that. Quite often they have extended themselves into becoming accounting systems as well. So for instance, there are SAS modules that deal with accounts. So there can be quite a blurry line between data systems and accounting systems. And a lot of accounting systems started off life as data systems or were built over the top of those data systems. In terms of actuarial systems, we have the likes of Prophet or Moses or Monet, or I'm sure there's a whole load of other ones that are around. I don't want to endorse any particular one. They're all much of a muchness, although they all have particular areas of focus. And as actuaries, this is where we focus our work. Having said that, we also use Excel a lot. I don't know of an actuary who doesn't use Excel on a regular basis, and it is still used in preparing accounts a lot. There's always going to be books of business that are not large enough to justify the expense of putting in place a full actuarial system, a full accounting system, and everything is still going to be done in Excel. Not everyone wants to get a full data system or an actuarial system or accounting system. Sometimes we will generate bespoke systems in R or Python or Julia or Taiki or any of the other programming languages that provide us very fast results that are highly specialized for a particular block of business and a particular calculation. And if you're writing code to do a stochastic model for a block of business that only you write in a particular fairly simple regulatory environment, a bespoke system can produce a very fast result, but it does require slightly more costs to implement and run than, for instance, a pre-designed system. So each of these systems has their advantages and they all have their disadvantages, but they are all part of the accounting landscape that we are trying to automate. So in the old ways, back in IFRS 4, you had an actuarial system that did a stochastic calculation. You then used an Excel spreadsheet to download those results, maybe format them. You then sent that spreadsheet across to the accountants and they said, thank you very much, we'll stick this straight into our financial statements. The insurance liabilities were the responsibility of the actuaries. They're added in at the account level. There was very little interaction with the accountants. If they queried a number, maybe. But beyond that, there was no real need to actually talk to the accountants, and they probably didn't feel the need to talk to us either. There was very little interaction, and they didn't understand us, and we didn't understand them. That is very much changing with the introduction of IFRS 17. Actuaries are involved at pretty much all levels of the accounting process, and so are accountants. The accountant is going to be interested in your stochastic projection as much as you are going to be interested in their release of CSM. The whole process is integrated, and this is why we need to have integrated systems. So one way of looking at it is to extend the data systems. So every insurer is going to have a data system for managing their policies, managing transactions, etc. So that feeds into the actuarial calculation. It feeds into the accounts. So why not extend this data system so that it does the actuarial calculation, it does the accounts? There's probably already a module that you can add to your data system that does the accounts anyway. So that bit's simple. There's code in the data system that will enable you to build an actuarial calculation within it. That bit's more complicated. Most data systems, up until recently, haven't had actuarial calculations in, but they will usually try and sell it to you as though, yes, this bit's easy. We've done it multiple times before, and don't worry about this. Your project will come in on time and on budget. And then they actually hire an actuary to come and do it and realize that it's not quite as simple as they think. But it's definitely a way of going. I have built out actuarial calculations within SAS. The data's already there. You do your actuarial calculation, you feed it to the accounts. The accounts feeds back into the data system, and it happens. It works. So that is definitely one of the ways of doing it. Another approach is to take your actuarial calculation and extend it into accounting calculations. So we're already doing all of the actuarial calculations. IFRS 17 says we need release of CSM, etc. We can do that. We can group it up. We can package it to look like accounting information, and we can provide almost everything they need, but probably not exactly everything. So there will always be cash accounting elements that need to be allowed for. There will be claims that aren't necessarily within the actuarial system. We deal with expected claims. We don't always deal with actual claims in there. We've got premiums that we expect to receive, but do we account for the premiums that we don't receive? Do we account for what happens when we receive more premium than expected? So extending the actuarial system can work, but there's usually elements that are not considered within it. And we also don't usually consider extending it back to the data because the data is very specialized. It's been used in a lot of systems. You're not going to be competitive if you try that. But extending forward into the accounting system is definitely a possibility, and definitely something that has been done and considered by a number of the actuarial systems. Alternatively, you can take your accounting system and work it backwards and say, we've got a calculation system here. We can do the actuarial calculations in it. It happens, again, I think the effort required to do it is often underestimated. But it's another system that I've worked on cases where this has been done. And again, they tend not to say we'll do the data as well, because the data is all already there, and it's an established system. So why would you do that? And also the accounting systems are very often built on top of data systems anyway. And then you have bespoke systems. Now, there's no reason why you couldn't use bespoke system for your data, your actuarial calculation, and your accounts. I think in general it's more likely to just be for the actuarial calculation, and then formatting things to go into the accounts. But it's a bespoke system. You could do anything you want. You could build your own bespoke data system. You could build your own bespoke accounting system. It's unlikely to be a good way of going about it. There are going to be market available systems out there that will do this for you, and you'd largely be wasting your time. But for the actuarial calculation, I think a bespoke system, can and does work, especially if you've linked it into your pricing system, which can work very well. So you've done your actuarial calculation. How do you get your system, your calculations into the accounting system? Now, usually this would be done at the accounting journal level, and you'd be generating accounting events for that. So an accounting event is an event that goes into an account, essentially. So if you receive the premium, well, you're crediting cash into the account, but at the same time, you're creating a liability. Someone has paid you that premium for a purpose. They expect some insurance as a result. So 1st of June, someone pays £100 premium, credit £100 in the account, you create a liability for £100 in the present value of future cash flows. Something similar happens when you start a new contract. For some reason, I've got initial measurement in there twice because I've merged those cells and not deleted it. But so when you have initial measurement, as well as having a PVFCF that happens with the premium receipt, you're also setting up a contractual service margin, and you're setting up a risk adjustment for that contract. Each of those would separately be an accounting event that would be calculated within your actuarial system, added to either your flat file or your data feed, and pumped into your accounting system. Likewise with the change of estimate, so you come around second valuation period, estimates have changed, you tweak your PVFCF, your CSM, and your risk adjustment by setting up accounting events in your system and feed through into your accounting system. Likewise, when you amortize your contractual service margin, you're recognizing an element of insurance revenue. So you're going to reduce your contract service margin and you're going to increase your insurance revenue. So you've got a release into your insurance revenue. That would be an accounting event that gets pushed from your actuarial system into your accounting system. Claims payment, termination of contract, anything else that has a monetary value and affects the management of these contracts, they'll all happen as accounting events and they'll all get pushed through. Some cash payments, for instance, may not go through your actuarial system. They may just go directly through from the bank account into the accounting system and directly into the accounts from there. You would never see them in the actuarial system. So, for instance, wages would never go through there, never go through the actuarial system, but they would go through the accounting system. So, it's not as though you can do everything in the actuarial system, but you can do pretty much everything. So in terms of your accounting events, if you're setting up a system that you want to use for them, you are going to want to have a data contract between your accounting team and your actuarial team. They want to know what data to expect. You want to know what data to provide. So you set up a data contract that tells you the format of the system, how often it's going to be sent, what it's going to be sent as. Is it going to be a push or a pull? I'd recommend a push. So there's no good the accounting system pulling data from the actuarial system if the calculation hasn't actually finished yet. So in terms of what you actually want in there, you want the calculation date, and you quite possibly want a timestamp as well. So if you're going to be rerunning calculations as and when you find errors, that would be useful. The event date, so that is the date of the accounting event. So premium was paid on this date. CSM was converted into revenue at this date, for instance, and that will enable it to be in your chronological accounting journal in an appropriate point. Group, so we're doing this via IFRS 17, so there are specific rules around which groups things go into. So you'll have set those all up in consultation with your accounting friends. You'll set up rules for how those groups are defined. That needs to be in your accounting events because that is how the calculation is done. That is how it is passed to your accountants, and that's how it's recorded and grouped up into accounts. Likewise, portfolio above group. You'll also want to specify what that is. You know, every accounting event has a monetary amount. You know, you've paid a premium of £100, therefore that goes into your journal as an amount. It has a debit account and it has a credit account so that you can create a double entry balance sheet. And if you are dealing with a multinational business, you're also going to want to have a currency for it. Now, I consider these to be the bare minimum of what you want for accounting events. You will quite possibly want to have further information as well, such that you can, for instance, enable your auditors. There's a whole load of other things that could well be considered to be in here, but at the very minimum, this is what you want to have, and you want to make sure that you've got. So when you are designing your accounting process, one of the key considerations that you are going to have a lot of time discussing with your accountants, and everyone is going to have strong opinions about, is how you determine the movement spaces. There are two main ways of doing this. One is year to date, and the other would be period by period. So what do I mean by this? So on a year to date basis, we are showing the movement between the previous year end and the current date. And we are ignoring any previous reports that we have done between the year end and the current date. So if we're in the third quarter, we are reporting 3 quarters worth of data at once. If we're doing period by period, we take the Q1 and we take Q2 and we take Q3 and we add them all up together and we get an incremental reporting basis. Now, one of the advantages of year to date is that the system is more robust to errors. So if you have to go back and restate something that you did in Q1, if you're doing year to date, that doesn't actually change what you have to do. But if you're doing period by period, you then have to restate Q1, Q2, and Q3, which for new systems and new processes is actually quite important, because you can almost guarantee that you're not going to get it correct the first time. You can guarantee that there will be corrections that need to be made, and avoiding having to go back and make these corrections in multiple accounting statements is a good thing. However, having said that, period by period does generally feel more natural to actuaries. Feels, it's more aligned with what we've been taught, and generally it's more aligned with a more mathematical approach. But it's not necessarily the best method in terms of accounting. So how do you deal with errors and also changes to assumptions? So one method is to reverse and replace your accounting events. So each time you start a new period, you reverse out all the accounting events from the previous period and put new accounting events in. Alternatively, you make an adjustment entry. So you say, okay, this accounting event was wrong, we'll put in an adjustment to modify that. Now, reverse and replace is more audit friendly, and it can be applied to any changes whatsoever. However, it does have twice as many entries as adjustment entries, because obviously you are putting in a reverse accounting event and you're putting in a replacement accounting event. So if you're expecting to do a lot of it, you'll very quickly explode your journals. Adjustment entries can be considered easier. It keeps the audit trail simpler. You've got a single report which can be traced, and this is often used for smaller errors. But whatever you're doing, you should always document why you've made the change and with what data you have done it. Audit reconciliation and traceability. So, as I mentioned earlier, accountants are going to be responsible for the whole of the accounting process. They can't just say, oh, well, those are liabilities, they were calculated by the actuaries, go and speak to them. They're now interested in everything. So they are going to be interested in reconciling down to the accounts in individual calculations. So we need to be able to create an easy reconciliation going from the trial balance, where they're trying to make adjustments. You want to be able to trace that calculation back into the actuarial system and potentially back into the data that's sourcing for it. So we need to set up systems for tracing that data. Can the auditors trace back? You have a 10,000 profit. The auditor wants to know where that's come from. Can he see invoices that support that? And going in the other direction, you want to make sure that all of your contracts and all of your liabilities are actually recorded in the accounts. So traceability needs to work forwards and backwards. You need to make sure that everything is in there, and you need to make sure that nothing's excluded, nothing's in there twice. Things like checksums, making sure that you've got your correct number of policies, correct number of policies, correct number of contracts, correct premium. You can trace that all through the system and make sure it adds up to what you're expecting it to. But this is a consideration, and you will need to discuss this both with your accountants and with your data team as well, so you can get something that works for everyone. So there we are. I seem to have finished 5 minutes early. In terms of closing remarks, I think it's important to make sure that everyone's involved in this process. You have a data team, you have a team of accountants. You're all going to be working very closely together to get this over the line. And you need to make sure that you're speaking the same language, the correct language. Accountants have a funny term of funny jargon. You need to make sure that you understand what they are saying, and equally, you need to make sure that they understand what you are saying. You know, I've written papers explaining why the retrospective calculation is the same as the prospective calculation, just to prove it for a calculation, so that they can confidently say to the auditors, you know, we accept this. They've never needed to do that before. They've never needed to understand prospective calculations. You know, from an accounting perspective, usually everything is retrospective. So, you know, they don't understand actuaries, and to a large extent, actuaries don't understand accountants. So be clear. Even the simplest things can cause misunderstandings. And with that, I think I'll break and say, do we have any questions?